All right, good morning, everybody. Happy Friday. Here we are live, end of the month again, doing our presentation, Facts, Not Fear. The purpose of this monthly webinar is I get together with a couple of people that are a lot smarter than me, and we put together a presentation of what's happening in the South Florida real estate market. There's some national information that we'll put in there, but it's mostly focused on South Florida. My name is Ernesto Vega, broker of and founder of Canvas Real Estate. My wonderful co-host to my right is Larry Singh. Larry is a certified instructor, a Gold Coast master instructor, right? And a district manager, Canvas Boca. So good morning, sir. How are you today?
Good. How are you?
Anything exciting that happened this week that you want to share with all the population watching us?
Things that are exciting this week is, and I think we're going to get into this a lot more, is how we've seen the real estate market just, bounce back from, everybody being locked up for so long, right?
Have a good graph on that bounce. For those of you who are tuning in the first time, what we do is we go through information that we collect through different sources to give you meat. So when you're talking with your buyers or your sellers, you can speak with context and make sure that you come across as knowledgeable as possible. My opinions and Larry's opinions are our opinions. It's what we think. You can differ from it, or but I just want to put that disclaimer in there. If you're watching us live right now in any of the social media channels that this is going live in, if you can do me a favor and click that share button, send that to everybody that you can, so we can get some information. And it's all not positive information. This is one thing that I like about me and Larry. It's not roses, butterflies, and rainbows. We're going to tell you the good, the bad, and the ugly, and you got to adapt your business to the good. Forget the bad, forget the ugly. Focus on the good so you can be productive. Right, Larry?
Yes, sir.
All right. So
the one thing I like about these conversations that we have is, everything we have is fact-based. So you're like me. I'm an information nerd. So I like the statistics and all of that. So we're gonna give you guys.
He's a statistic nerd when I'm texting him on Father's Day, telling him to get off the computer. When he's emailing me on Father's Day, I tell you. All right, so let's go ahead. Let's throw in. Let's share my screen, and there we go. Dun, 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 dun. Perfect. So market update, June 2020. Yes, it's June. I know it feels like this year is going in reverse, but it's June. We are moving forward. We are doing progress. There's good news, bad news. It's just news. So I'm going to just flip through it. This is my co-host who you're watching live, Larry Singh, master trainer extraordinaire, right? If you have a license in South Florida, more than likely you got to thank him for that reason. And he's also very proud to be associated with us, a district manager in our beautiful Boca facility. How are you today, sir?
Good. I'm great. How are you?
Good. Me, Ernesto Vega. You're watching. The picture is pretty similar, I think. Actually, even the shirt sort of matches today. Thank you for tuning in. And once again, if you're watching us any social media, do us a favor and click that share button. We're going to go through charts and information regarding real estate, the economy, and what affects the real estate economy, because that's what we are, real estate professionals. We want everybody to stay tuned and understand what affects the economy and what makes it the economy what it is. I put out a post on earlier this week that I just had to share at that moment that, you know, real estate, the biggest mistake you can make is pretend you work for anybody else. You work for yourself, so you got to prepare and educate yourself to take your career forward. So I need you to understand this. You know, we are all very, it's a long marathon, um, getting a cramp, and you got to push through. You know, we're in 2020. This is gonna keep going forward. This is gonna keep moving. So you gotta keep your eye in the future, right, Larry?
That's right. You always have to keep your eye on that. That's one thing that's the one of the most important things. Know where you're going.
Yeah, you gotta have that plan, and you gotta adopt a plan, pivot, shift. There's a lot of words being thrown out there by lots of people. You have to adapt to the new market, and the market will keep changing. As a matter of fact, my first text to Larry today was presentation we did last night. There's already some outdated information because some new data came out today, but we're gonna talk about that data at the end. So let's talk about unemployment. To me, and I'll let Larry give his 2 cents. We don't agree on everything. To me, the biggest driver of real estate or the economy is unemployment. Unemployment uh, fosters consumer confidence, spending, everything that has to do with our economy. It's what unemployment. And there's no way we should hide this graph, because this graph, I think, economics teachers will talk about this for years and years and years to come, which is, you know, going from the lowest unemployment rate we have ever had as a country to one of the highest unemployment rates we have ever had in a matter of 30 days. But if you look at that graph and you look at the top of the graph, what you see here is you begin to see a contraction. Now, this is a national number. I'm going to give you the Florida number next. And, you know, yeah, real estate is hyper local, but whatever happens in the rest of the nation also affects decisions of companies in South Florida. So the reason I show you this graph is to understand, yes, it's a dismal graph to look at when you look at unemployment, how many families are going through so much. There's a phrase that I said over and over, we're all in this together. Yes, we are all in this together, but not everybody is going through it the same way.
Right.
So we have to have a lot of empathy for everybody, because not everybody is as blessed as you are. But Larry, what do you think of that little top of that graph right there when you begin to see the drop?
Well, it's very exciting when you start to see the drop on it, right? I think, you know, we all look at this graph as unemployment, right? But we have to actually think about what we're going through as a nation and really decide if that's really unemployment. Because a lot of this is temporary, right? Majority of these people from the statistical standpoint are going to eventually go back to work. So is that true unemployment for a specific time, but it's a temporary situation. And I think this graph is starting to depict that this is temporary. As the country starts to open up more and more, you're going to see this start to go down further and further.
And I'm not a V recovery guy. I'm a Nike recovery guy. Right. So I said that. You can look at my video from 3 months ago. I have never said that this will be a V recovery. I think this will be a Nike recovery, a swoosh. But I think that this is a great start. This is unemployment beginning to drop. So this next graph touches on what Larry just talked about. If we look at the unemployment for temporary job loss and temporary layoffs, that is the majority of unemployment. The majority of people unemployed in the US right now are either furlough employers or temporary layoffs, which Larry touched on. There will be jobs that will be coming back into the market as we, you know, I know we're going through a new spike in cases, and some states are holding back their reopenings, and reopening is going to look probably a little different than it looked a month ago. So this number, we don't know what it will be 30 days from now, but it's good that a lot of the unemployed people are already beginning to come back to work. So I know that you just touched on that, but if you can expand on temporary layoffs and temporary job reduction.
So what we mean is, especially here in South Florida, right? Because we always talk about the localization of real estate, right? Especially here in South Florida, compared to the rest of the state, we have to remember South Florida is a tourist industry, right? And the hospitality industry is one of the hardest hit through this whole pandemic, right? So you have these big hotels like that have laid off people because of the pandemic and because of the CDC guidelines of not having people and observing social distancing. But that's a temporary situation that we're in. Those people will eventually go back to work because South Florida, being a tourist market, will have to accommodate those people once travel fully opens again and once tourism starts again. So when we talk about a temporary decline or a temporary increase in unemployment, it's just that. It's a temporary situation. I know some people were worried about, oh, well, we have this market, it shows this many unemployed people. Well, think about it in perspective, right? We came out of one of the best employment situations that we could have come out of. You know what I mean? We started at 3%.
Yeah.
And now we're at 13. And I think it has a little bit to do with, for the last 3 months, under government regulations, the country was shut down unless you were non-essential, right? So is this really unemployment? No, it's a snapshot in time. And I think we have to remember that. I think these people are definitely going to go back to work. And that's just like I said, my opinion on it. But all these people are not going to be out of work for, forever. The country will reopen. Tourism will continue. Hospitality will pick back up. And we're already starting to see it. This graph is showing already that we're already starting to see that.
Yeah, so it shows a 30 days, a 5,000 to 10,000 drop.
Right.
Yeah, and we're not saying that this is all fantastic and there will be a 3% in the blink of an eye.
No.
You got to understand that for the economy to have a healthy balance, we need to have unemployment somewhere around 7%, more or less, to have a healthy balance of people not working and people working. So even if we are at if we end the year or roll into 2021 with a 9 to 10% handle on unemployment, that's a 3% increase. That's a huge number, but it's not something that we haven't worked through before, right? So that my take is, just like the inventory it's completely out of whack right now. We'll talk about real estate inventory next. That you need to have a balance to maintain pricing and affordability. You need to have a balance and unemployment, and that way, we don't have beyond wage increase, and things cannot move forward. So if we end up at 9.5%, 10% ending the year, it's bad, but it's not the end of the world. It's not the end of the world. This one is the one that I like because this is what we've been saying for the past graph. Unemployment claims. March came around, March, April, boom. We had literally, there was the drop the mic moment, Mm-hmm. We had a huge unemployment claims. Now you go into June and, we're seeing there's still claims, right? There's still claims, but they're tapering off, right? They're tapering off. So the unemployment, it's not going to keep growing. It's going to begin to decrease little by little, but it's going to decrease. So when people say, hey, Ernesto, there's a market correction coming, and there's going to be a crash twice as big as 2009, I'm like, let's look at unemployment, consumer confidence first. Then let's wrap our hands around inventories, and then we can talk about what's going to happen with that. But I look at this as a gleam of hope. Unemployment, that people are not getting laid off anymore and not at the same rate. and that will help all of us in the long run.
No, I 100% agree with you. And we look at statistically how the virus increasing or decreasing is really affecting the unemployment rate, and it has a direct comparison to that. If people say that it doesn't, I mean, I don't know what graph that they're looking at, but it does. As cases increase, the unemployment rate stalls or may even go up a bit. But as the cases decreases, if we look at the states that the cases decreases, the unemployment rate is shooting back up, because these people are as business owners, as employees, they're wanting to go back to work. They're wanting to continue with their lives. So I think the weekly unemployment filing, I think that's a big indication of where we're going. And if you look at it, that big curve that you see in the drop of claims, I mean, I think that's key.
Yeah, that's looks like a ride at Disney.
Yeah.
Now let's break it down to our wonderful state of Florida, right?
Mm-hmm.
So Florida, the highest unemployment ever was back in the end of 2009, going into 2010. And somehow, as of Thursday, these are fresh numbers. This is from the Employment Bureau. As of Thursday, we were at 74,000. I think this is new claims in Florida. Now, the reason the claims took off last week in a brutal way is what Larry opened with, the service industry. A lot of hotels, so they're reopening, they're reassessing bookings and adjusting for personnel. Same thing with the cruise industry. The cruise industry was going to open, I believe it was in July, and now they have pushed back to October.
Mm-hmm.
Disney is still going back and forth on their openings. So all of these big employer incentives, right, of service-related employments have taken a step back on when they're going to open the door. And then a lot of furloughed employees have been terminated because businesses have to adjust to the new business model. Now, is this a scary number to look at? Yes, it is. Now, is this the end of Florida? Are they gonna cut us off the map and push us off into our own country? No, because I have a slide coming up that I need you to look at with empathy, because at the end of the day, these are families without income, but it's a number that you need to understand. We're talking about the service industry being the one that is the most affected at that moment. At this glimpse in time, this is the one most affected at the moment.
So just to touch on that a little bit. So last week, yesterday, the Sun Sentinel put out an article about the hospitality industry, right? And they were saying that the W Hotel was saying that they're renewing their temporary actions. Now listen to what I said: the temporary action that they have taken due to the corona pandemic. Now, and that's including the furloughing of their employees and stuff like that. They're renewing that for a specific amount of time. So when we look at it, we're looking at it from a safety standpoint, and how that safety standpoint is affecting the economics of the state right now, right? So according to the Department of Economics Opportunity, they all are in agreement that this is only a temporary thing just to keep people safe. We don't want to have all these hospitality industries open to spread this even faster and further. You know what I mean? So we have to keep in mind that this is temporary. Hotels have already said that they're going to bring back their employees. A lot of these hospitality places are saying that they're going to bring back, and they're starting to open slowly to see the effects of what's going to happen. And we have to keep that in mind.
So there was a comment on that article that I was reading on Twitter, and somebody was talking about the W in South Beach. I think they mentioned the W in South Beach, and how that hotel was going to be decimated. I'm like, first of all, like you said, it's not someone from South Florida. I'm like, Floridians are very resilient.
Yeah.
We have been through from Andrew on and the hurricane of 1926. I mean, Florida has always been through, and Florida always bounces back.
Right.
For someone to say that the W in South Beach will disappear, you know, anybody in the U.S. that wants to go to vacation, South Beach is a place to go.
Right.
And I know that maybe 2020 is not the year, but you know, this will too be corrected, and we will move forward. And there is nothing most beautiful than that area in Miami.
Right.
So it's a temporary issue. We just gotta adapt. The U.S. real estate agents have to take your business to where the business is, and not where the business is not. So this is the graph that I want you to look at with empathy in your heart, right? So this is a breakdown of all those unemployed, breakdown of those 74,000 unemployed people that just filed. This is a breakdown of their income. And so this is what you got to understand, that this is a renters, a majority of these unemployed, I mean, 60% of these people unemployed at the moment are renters.
Right.
Right. So, but at the same time, if the renters are getting some advantages with some municipalities passing some bailouts for them to get, like, rent can be paid.
Mm-hmm.
And most hedge funds are now buying rental communities more than ever.
Right.
There's been 3 large acquisitions in the past week. So the majority of the unemployed in Florida, like Larry said, it's this graph it's families. This is not personal high income. Family households with less than $100,000. 60% are those, which is, if you want to break it down, a majority of our rental communities.
And it's also, you know, like I said to you before, South Florida specifically is a huge hospitality industry. So hospitality got hit the hardest. So all of those people are now unemployed temporarily because of the pandemic. So you have to kind of put it into perspective. Yeah. You know, those hospitality workers, a lot of them may fall within the first 2 brackets of that graph.
There's a graph I was trying to find because I read the article and I couldn't find it. Maybe I'll get it for next month. Talking about Floridians and the adaptability of Floridians. Mm-hmm. There was talking about how this segment of the population that has jumped into the gig economy, how many of them have jumped into Instacart, Uber. They have adapted to the jobs that exist. Right. Immediately. It's like that. They flipped the switch and they said, okay, so I cannot be a bellhop at the W. Fine, I'm going to jump and be an Instacart for the time being. Mm-hmm. So so you know, Floridians are very, very, very adaptable. If not,
look, so, we overcame adversity when we didn't even have all this digital things to lean back on, right? Exactly. When Andrew hit, Andrew decimated entire cities. Decimated. I mean, I remember seeing pictures of, you know, houses were just piles of rubble. And not only did we come back from it, we came back stronger from it. So we all have to remember that. I agree with you 100%. Floridians, they know tragedy and they know how to deal with it and they know how to overcome it and make the best out of it.
Roll up the sleeves and keep pushing.
That's it.
All right, so this one is this one is consumer sentiment. This is how we feel, because we all are the consumers, about the economy and where is it going, and if do we feel comfortable spending our money, right? Mm-hmm. You know, spending our money. So prior to this, I mean, February ended with the highest consumer sentiment, I think, ever in record in Florida. We were all happy, content, spending our money. And then, like Larry said, the government shut us down. It was like, you know, go home and stay home. If there was any doubt that consumer sentiment, fear, and panic was going to set in, I don't know where are you from? Because if you're told you need to be home and you need to be home, I mean, when they tell me, oh, consumer sentiment fell only by 30 points, I'm like, it should have dropped 100 points. Yeah. Because I mean, not ever in history this had happened in this country. So we had a 30-point drop in consumer confidence. We had to. There was, I mean, they had to happen. But if you look from April to May, consumers began to already feel a little more comfortable and spend a little bit more money. So when the June number comes out, because this information comes out a month later, and I'll show this to you guys in July, I think we will be in a better place with consumers spending. I think we will be somewhere about the 80 some percent, if not higher. But I see it that we went from 102%, let the party go on, to literally they turned off the lights, they turned off the music and said, everybody's got to be home now. Mm-hmm. And we all took it well. I mean, 70, only 30%, got afraid. So I see an uptick going back to that swoosh recovery, right? So
I have a little bit of statistics that I want to point out to everybody. So when we talk about consumer confidence, right, we're talking about indicators that for spending, which translates to dollars and cents, right? How people are spending their money and how that influences the economy. But if you look at people that are at home, right, they have to be at their house. There was an article put out by Center Square from the Florida Bureau of Economic and Business as of June 4th, right? So it would have been May's numbers. If you look at what it was, it's exactly what you said. There was a 9.3%, 9.3 points increase in consumer spending in household appliances and stuff like that. Because why? You're home. So it's a shift from one disposable income to things that you're going to need in your household. So the retail portion of it may have dropped, but look at where it was respent. If you look at the grocery stores, I can guarantee that you see surges in spending in the grocery stores, in consumer appliances, things of that nature. That has to do with more household stuff because their focus is more on their house. If you look at it, it shows that the spending is still there. It's just being reallocated.
Yeah. So this one is the same. So consumer spending affects our gross national product. That is where, how we sort of track the American economy. So Goldman Sachs, if you don't know who Goldman Sachs is, we need to talk in a separate conversation. All the smart money in the planet, I think, it sits with them. So they gotta be, their analysts have to be spot on. They cannot be guessing it like me, right? But their projection still the same. They think that we will, our GDP will drop brutally. And then as 2020 moves forward, it begins to correct. And as we begin 2021, we will be a negative 4% GDP, and then we will be somewhere at the -2, -3 at the end of 2021. So it's going to take us some time to recoup from everything that took place, right? And what you got to look at this one is it's the blue, the dark blue is services. Services is what we keep talking about, the service industry. Right. The service industry it's gonna take a while to reel from, unless there's the vaccine or the preventative or something comes out sooner and it's tested and approved and it works. Then that will they'll make the consumer feel a lot better. So I keep going back to this graph because to me this is. And if you look at building investments, it gets decimated, and then it sort of begins to taper.
What I find interesting on this graph, Ernesto, is two things, right? One, how it is just like a Nike swoosh one, right? And two, if you look at the service consumption effects, it's almost half of what everything else is. the manufacturing effects and building effects. So before we even move on, I just want to clarify something for everybody that's watching that doesn't know what GDP is. GDP is the total monetary and market value of all finished goods, services, and products within the country's borders, right? So it's the value of that. Real estate, and I've heard you say this numerous times, right? Real estate associated industries make up 21% of the GDP of this country, right? So it's a huge impact on what we do. If we look at this, those service, and we keep talking about that service industry because South Florida is so dependent on that service industry, right? It makes up half. And if you look at it, as everything else shrinks, this is the second point I like on this graph, as everything else shrinks, the service consumption effects shrink, but not at the same rate.
Yeah, that's an industry that's gonna take a while to it's gonna have to reinvent itself. Talking about how things are moving at a pace that is unbelievable. A headline just comes out from American Airlines that beginning August, they're going to no longer, they're going to fully book their planes because demand has grown up so much, right? So there's so much demand that they're already beginning to increase flights. Now, we finished with the economic part of the session. I'm glad you tuned in and you didn't fall asleep for that part. So congrats to you. Now let's talk about real estate. Let's talk about what me and you do for a living.
Yeah.
So buyer demand skyrocketed this month at the highest rate that has ever been. I mean, it was 18% higher buyer demand in June than it was in June last year. I mean, so we sat at home for a month, but we got out the door and we said, this house is too small, this house is too big, this house is too old, right? Mm-hmm. Rates are cheap. Let's go ahead and let's take advantage and buy a house at this moment. So the consumer confidence is down. Housing confidence is strong because, I mean, there was pent up demand, but that pent up demand ran out the door immediately. And I wanted to share with everybody that, although last week volume application was short, what buyers sort of contracted, we're still 18% high for the year. So that is a huge number. Otherwise, it'll be 21% up for the year. Now, out of that number, because everybody says, oh, yeah, but everybody's refinancing, Ernesto, that's why mortgage applications are up. No, my friend. Only 12% of all applications are refis. 12%. That means that 88% of all applications are the people that you gotta be selling a house to because they're buyers.
Right.
So yeah, there's an uptick on refis, but not as much as you think so. Now, this is what you gotta focus on because someone asked me yesterday, where do I put my energy into? And I think the first-time home buyer and the workforce housing buyer, that entry-level buyer is the one that is really gonna take advantage and gonna help us carry on through pushing forward. So last week, FHA applications were up, and so were VA applications. That means that first-time home buyer is really looking, is not staying on the sideline. It's comfortable and with their job and their future, and they're jumping in head first into the home buying season, which was delayed, but the home buying season, I think, is still in place. What's your take on that, Larry?
I think you're 100% right. I've seen it in the market itself, and I've seen it in articles as well. When I say the market itself, I've seen it out of this office. People look at things in a very a linear state, right? So it's very one tracked, and they say, well, we didn't close as much in April, for example, right? But it's all relative. Did you have as much to sell in April as you did, right? So I like this chart because it shows in factual statements that we increased 0.3%. That's a huge number.
Yes.
Especially coming out of, nobody being able to do anything. That's a huge number. We're still showing growth and increase. And it shows how how stable and how rock solid the South Florida market is, in my opinion.
Yeah, yeah. And now, if you look closely at this chart, this is a purchase applications. It says buyers sitting down with a lender and taking an application. We know we work a lot with CMG, and this is the national number. And I want you to look at this graph. By the way, a couple of people are texting me. Yes, I'm going to share this presentation. I mean, everything we do, you can have it. It's not proprietary. It's information. We put it together. Even if you're not a Canvas agent, it's not a problem. You can have it. You can edit it. You can do whatever you want with it. But this one it's the number. You know, applications went down and applications went back up, right? So that is that V that everybody talks about, right?
Mm-hmm.
So applications moved. And then the counterbalance of our market, we got buyers, we got to find sellers, right? So this next number, which you're going to hear a lot more because there's a bunch of articles that have come out today, is buyers in a forbearance stage, buyers that have reached out to the lenders and have taken an assistant to help them get through this hump. So like Larry says, we were locked at home and that number peaked, right? But if you look at how many buyers on the week of the 8th to the 14th asked for forbearance help, that number is way, way, way lower.
So I just want to kind of put some perspective on this for a lot of people, because people may say, oh, yes, these numbers are, you know, going down and all people are applying for more, but you're comparing it to, you know, last month where everybody was locked down. So yes, it's obviously going to be more. So I just want to throw something out there as we're talking about Fannie Mae and Freddie Mac rates, right? According to the National Association of Realtors, first-time home buyers were responsible for 36% of sales in April, okay? Up from 32% of April of 2019. So there's a 4% increase from 19 to 20 in the middle of a pandemic.
Exactly.
So think about this rationally. If we talk about if we never had that pandemic, what would that number be like?
16%.
Yeah.
I mean, we had consumer confidence at 102%. No one's ever felt more comfortable about an economy.
Right.
So this one, this graph has a dark side, because this graph has a lot of people in a stage of asking for assistance, and it's either 6 months, 3 months, or 1 year forbearance programs that were put out there, and we're gonna see what is the end of that at some point in time. A percentage of those will be listed for sale, and yeah, will there be some foreclosures on them? Yes, but you gotta understand that there's a timeline for a forbearance and then a timeline for a foreclosure.
Mm-hmm.
If you're expecting a foreclosure spike in 2020, you're way too early. You're way too early. You're wrong.
Agree.
There might be some spike, some numbers in 2021, but it's not. We gotta understand there's a lot of things that could happen between now and then. Just like the federal government has jumped in and assisted a lot of banks with bond buying and all this stuff that's taking place. We don't know where we're going to be in November, December, January, and what programs like hemp could come back in to assist these owners in distress, because the majority of these buyers, I jumped too quickly. The majority of these buyers, the majority of these sellers are Ginnie, Fannie, and Freddie loans. These are loans. I think 70-something% of everybody in forbearance. And let's understand, when someone says to you, Ernesto, it says to me, Ernesto, this is 2009 all over again. And I said, well, 2009, we had almost 11 million homes in default. Not forbearance, default. People that stopped paying the mortgages. The only way to get the property back was foreclosure, right? And I think you know a foreclosure attorney very well, right?
Yes, I do.
So right now, I think it just uptick a little. We're at 4.6 million homes in forbearance and some stage of forbearance, foreclosure, tomato. Now, wow, Ernesto, we're at 4.6. Wait, January 2020, we were at a million. There's always going to be foreclosure cases. There's no matter how good the economy was, we're always going to be in foreclosure cases. Right. So we take that million off the table. We're at 3.6, 3.7 homes in some stage of foreclosure, which are now called forbearance. More math. Only 76% of those are federal government-backed loans, Ginnie, Fannie, and Freddie. So quick math, what, 2.5?
Yep, right around.
So you got a million loans, a million homeowners that have a loan with another creditor that might not be as flexible and helping them in the future. A million homes coming into the market staggered through a year or maybe two, not going to create an impact anywhere.
No.
And remember, I'm mostly talking single family homes. The condo market is a monster we're going to deal with later. And I know there's a couple of people already asking me, they're texting me brickle. Not talking brickle, I'm talking single family homes. Right. But understanding numbers, a million homes were in some stage of foreclosure on January 1st. Forget May, January 1st. We're now at 4.6. I think we hit 4.7 yesterday. Let's take out that million, so we had 3.7. That 3.7, 76% is government-backed loans. I'm not saying that it's going to be done, but it was done in 2009. For those that were here in 2009, there was the hemp refis that came out to assist homeowners. I don't see how a government mandate who created this situation would not have a government mandate to assist and refi those through Ginnie or Fannie or Freddie to assist those families. I don't see how that wouldn't happen. But that's, once again, like I said at the beginning, this is Ernesto's opinion and Larry's opinion. But in my opinion, I don't see how the government would not intervene and create a refi program. By the way, the hemp program was very profitable for the government, very, very profitable, because the values went up, and in liquidations, they made a lot of money back. But we're at 3.6, yeah, 3.6 families. It's a big number, but it's not 11 million, right?
So we also forget, Ernesto, that if you bought your house 10 years ago or prior to that, there's enough equity built up just from the increases in the market for you to refinance it and come right out of this at a better rate than what you were 10 years ago.
Exactly.
So there's a good possibility that we're going to see a couple of upticks in the refinance side of it just to get out of this. But if you look at it, just by purchasing your house and staying in it 10 years ago or prior, you're in a position where you're going to refinance your house right now. Because let's be very honest, this pandemic coming out of this, we have not seen a decline in values. We just haven't seen what people are expecting. And when you look at how it's going to be, how they're going to get out of it, that refinance option for a lot of people, and that's not even into your calculation, right? No. If you say 25% of the people bought their house 10 years ago or prior, that even lowers that number over a year or two.
Yeah, no, there's a lot of variables, and that's why you gotta understand, because I want you to stay in this field. This is a career. This is my 26th year doing this. This is a field that you can make a career out of it. Not just, oh my God, the waters got muddy, I'm gonna run out. Mm-hmm. This is a career that will carry you through. You just gotta stay informed, and you gotta put your energy in what's gonna be productive for you at the moment. So the information that me and Larry are sharing is information that can help you adapt your business, shift, pivot, turn, whatever you want to call it. But you gotta adapt, because it is changing, and you cannot fight it, because you will lose it. This came out last night. I think this was my last graph at 11 o'clock last night. because I was about to go to bed, and then I checked one more time, and ta-da! We hit 3.13 fixed loans, and I seen a couple of them close lower than that, but that is where the rate is at. And I want everybody, if you want to do anything, this is the graph that you have to screenshot and send to every single buyer you are talking to right now. Because I took you back to 1970. Took you back to 1970. And you look at the rates today, 3.13. This has never happened.
Yeah.
Now, can they go lower? I don't know. But there, it gets to a point where it's no longer profitable for the lender if the rates go lower. Remember, this is all a business model that it's got to make money. But that is where we are today on Friday. So if you're working with any buyer and you're listening to me and Larry, screenshot, copy paste, send to them with an offer and say, let's do it today.
So just to put it in perspective, right, Ernesto, because we talk about these numbers and we really, this excites me, right? Because it really does. Because I'm going to tell you, because I don't think everybody really understands how important this really is. When these mortgage rates are at this kind of level, your home buyers can now purchase more property. They can purchase more of a property. So if you were at a $200,000 property, let's just say, right, for arguments, now they can purchase more than $200,000 because their payback rate is less. So their money goes a lot further. This, what'd you say, 1920s? This is
1970. Went back to 1970.
1970. We're in 2020, people. That's 50 years ago. That's 50 years ago that these mortgage rates were this low.
Yeah.
Are they going to go lower? Nobody knows. But am I going to bet on that? No, I'm going to try and take advantage of the opportunity that I have. This is the furthest your money is going to go in the last 50 years.
Yeah,
this should get everybody excited.
Yeah. What I look at is I go back to when I started my career, and that is somewhere around here. And that's where we were at. We were at a 7 to 8.5% rate. And mortgages were still done, houses were still being sold, business still took place. You just had to adapt and take the business to move yourself to where the business was taking place. But where we are at today is unprecedented. It brings up, and I'm gonna give it a pre-name, Larry. It brings up affordability. That 3.13, it increases the affordability ratio for home buyers. Right. It takes that $250,000 buyer to a $325 buyer. So it takes them from, hey, show me a townhouse to show me a single family home.
It changes people's lives.
Bingo. So this is the one that you got to screenshot. This is the one you got to share. This is the one that was worth staying on the show for, right, Larry?
Yeah.
Now, inventory. We're gonna start talking about inventory because that is the elephant in the room that all of you gotta help us fix, because inventory is way too low. So new home sales jumped up because there's a lot of incentives. If you're not familiar with incentives new home builders are giving, they're giving a lot. So new home sales jumped 16.6% between May and April. They were not expecting that. They said, we're going to throw some incentives, but everybody's locked on their homes. We're not going to sell any homes. Let's sit here and just dust them off. Nope. New home sales jumped tremendously. So they did not build for 2 months, but they sold everything they had in the pipeline for 2 months. So what does that mean? That means less inventories. And when you talk about Dave Broward and Palm Beach, we're very narrow. We got ocean on one side, Everglades on the other. We're 23 to 26 miles wide. We're out of dirt. We cannot build any more dirt. So whatever in developments are going up, you can see how they're being absorbed very quickly, with or without incentives. So a component that has always helped our market is new homes coming into the pipeline, and that has been the brakes have been put on.
Yep.
Because it has completely. But new home sales spiked. Like Larry says, no one expected buying to go up the high. No one expected new home sales to go the high, especially when you're in the middle of a pandemic. So
it's funny. It's funny that you say that, right? Because just to kind of give some context to this, I went to speak to a builder, and they had five move-in ready houses. That's it. Everything else was a year. 5.
yeah,
That's it. And this is a huge builder. This is one of the largest builders, and they had 5 homes, where typically they would have 3-4 times that. They had, and some of the models that they were selling, they didn't have any. They didn't have anything.
Yeah. So inventory is an issue in South Florida. It's gonna be an issue in South Florida.
And this pandemic made it worse.
Yeah.
Because everything that was selling was existing inventory. But you as a real estate professional, because you were locked in a house, because maybe you were doing listing presentations virtually, which would have helped this situation. But the reality is, a lot of the slowdown that we saw was based on people not feeling comfortable at that point in time, right? Now we've seen that changing a little bit, but at that point in time, people didn't. So there wasn't that much coming onto the market as new listing inventory. So we're going into this pandemic in a shortage, selling off a lot of the inventory that we had. Now we've made that even worse, the shortage.
And let me be clear, this is not investors buying. This is our family. This is the investors. I have another slide that's going to show you that. So with unemployment where it was at, with the contraction in consumer confidence, with all of the clouds and the storms facing, sales still uptick.
Yep.
Sales still uptick. So you gotta understand that. Here are the facts. Here are the news. Building permits. These are homes to be built, right? And this goes back to inventory. I mean, you're looking at. In April there was no permits filed to build. It came up in May. I'm waiting to see the June numbers, but we need to be somewhere around here. We're easily 20-30% down from what we need to be for permits, for new permits to be built. Because Larry said there's no inventory left. It's going to take them 5 to 10 months to build a house, depending on the developer. Actually, it will take longer because the municipalities are running slow. So we're probably looking about 10 months. So any project out there that it's not permitted, it's a year away from delivering the keys to somebody. And it's very funny to show a house and say, hey, yeah, you can buy it out, come back in 10 months. They want it now. They want it now. But so builders are jumping in, but not at the rate that they need to be. We're below 2000 summer 2019 numbers.
Yeah. It's very interesting to me to see how in a lot of instances the real estate market is actually acting in the opposite effect as to what people thought it was going to do.
Yeah. It's because it's the only solid investment when it comes to real estate, in my opinion, right now. And then this was a snapshot from Wall Street Journal. All the big players that were here before are now loaded with more cash than ever, thanks to the stock market values, and they're waiting for sellers to crack. They're waiting for sellers to crack because they made so much money in 2010, 2011 buying properties that they're waiting, and they're looking for that 20% in some areas. But they're, all of these big funds, BlackRock, all of these that were big buyers are still buyers. They're just waiting for sellers to crack. And the real estate. The word that was taught to me is real estate is local. I think real estate is hyper local, because Within Broward, there's some communities that are thriving, some that are stable, and some that, you know, are not. Same thing in Boca. There's some places in Boca that are beyond
Oh,
thriving and
absolutely.
some that are stagnant. Same thing with the county. So real estate has become hyper local, uh, because people, especially now more than ever, one of the comments on the chat was buyers are fleeing South Florida to more affordable places because of the pandemic. I agree. Some people are fleeing South Florida, but New Yorkers are like literally in a caravan coming down to Florida. People from Boston, all the Northeast, and Midwest.
Chicago.
Yeah, we are losing some, but we're gaining a lot more than we're losing.
Yeah, but Ernesto, we're not losing because they're not leaving the state. They're just going north in the state.
Yeah.
A lot of the people aren't leaving Florida. They're just moving to a different place in Florida. That's what people are not understanding. Florida has the largest influx of population than any other state.
Than any other state. Than any other state.
That's huge.
It's unbelievable. It's unbelievable.
You know, we've talked about this a couple of times before. You know, now with even a shorter amount of inventory, now what are we looking at? 3-4 times what we currently have just to get to equilibrium, just to get to a stable position. I mean, come on. We can't meet the demand of the people that want to be here.
Yeah, it's an interesting time. I mean, everything that should have happened didn't happen. And then for those thinking, oh, I'm waiting for the market to crash because I'm going to get myself a deal. I'm going to buy. This is how much smart money. And when I call smart money, I call it's managed money. It's hedge fund money that wants to jump back into real estate. There's $350 billion in cash sitting on hedge fund money, waiting to jump into real estate to compete against your offer with financing on it. So it's going to take a lot of real estate. That 3.7 million forbearance homes, they can buy that 2 times over and not blink.
Yeah.
So there goes all your stress inventory. All your stress inventory snapped out. It's gone.
So I was reading about this exact thing, right? About how hedge funds and major players in the investment circle are just sitting on cash, waiting for things to go, belly up and snatch them up as soon as they come on the market. So then the National Multifamily Housing Council put out some data on this, right? 80.2% of apartment households are making full payments through the pandemic. So now you're adding logs onto the fire, right? So everybody's sitting around stockpiling cash, waiting for the market to crash, right?
Yeah.
But then 80% of rental apartments are now paying in full month to month, right? Every single month. So now these people aren't going to have as much inventory coming on the market, but they're still just stockpiling cash. So when you try to invest in something, these are the people that they're going to go to. Now, yes, that's about the multifamily market, but when they get to the point where they don't want to fight in the multifamily market anymore with each other, guess where they're going to turn? Single family.
Because, I mean, it worked out very well for them. So as Larry was talking, I did some quick numbers because he got me excited about numbers. So if we take all forbearance properties in the country right now, every single home in forbearance, right? And let's say nothing gets done and every single one of those homes is foreclosed with a speedy foreclosure, which doesn't exist. Because if you want to talk foreclosures, talk to me about Louisiana, which has the most interesting foreclosure law that I've ever seen. But let's say that everything got foreclosed. Every single one of those homes is going to come into the market and it's going to flood the market, 3.5 million homes. All these hedge funds can buy all those homes today and still have 2.9 billion left over in their bank accounts without blinking. And that is at buying every home at the average sales price in the state, which is in the United States, is $376,000. So there is 3 times the amount in cash sitting on the sideline, waiting for that foreclosure wave that is going to destroy your market. So come on, friends, get educated, learn the stuff, learn the facts. You got to work, because this is an industry, you got to work, but understand that, this is not what it was before. Am I concerned about some areas and some markets? Yes, I am, but I'm not concerned as much as I was. So when NAR reached out to to a ton of realtors, 50,000 realtors nationwide, to understand what's the market going to be like for the balance of 2020, this was what everybody referred to. And to look at this, let me go to the next one, and we'll come back to this. So a great way to track where's the market going to be is to look at showing time. Showing time is the little app that you have in your phone. You should have it on your phone, that helps you book an appointment to show a house, right? So this graph is from the beginning of the year. Here you go. This is the end of February. You see how showing time was peaking, right? Then March started, and showings just boom. Here we are right before April starts. Showing times have dropped off a cliff. When we were right here, my friends, I was like, okay, this is interesting. There's no showings taking place, right? But then as April began to end, you see how the curve began to hit up. I'm like, all right, so stable number is right here. We're gonna get to stability, normal number. I'm cool with that. We're gonna go back to where we were in January, right after the holidays, because the holidays showings always stopped. This is real estate showings in North America right now.
And it's also adaptability. Now we have adapted to, that
we're 10% higher than the beginning of February, before anybody knew what COVID-19 was.
Right, because so before COVID hit, you're doing a lot of in-person showings, right? People were out of state, you had to wait for them to come in. You were doing an in-person showing. Now, during that COVID period, we adapted, and we've kind of gotten to the point where you no longer need to be in state. So now, not only did it meet what we were before the COVID started, it surpassed it, because of the fact that now we're implementing different technology to help us with showings. So now those people that were out of state or out of town that couldn't do a show, now you can do it.
Yeah. So that little graph is one of the things that you need to look at. You need to look at showing time and see the request to show homes, because that shows you the appetite for homes. And like Larry said, these are buyers. These are regular buyers. These are not investors. These are families making that investment. So in closing, this is to recap this whole hour we've been talking. Applications were up 18%. They were supposed to be 21%. It was a 3% contraction on applications last week. So we're 18% from 2019. Like Larry said, we're up. He keeps repeating this. All of this happened while we were all in lockdown. All of this happened when we were in lockdown. So applications are up. That means buyer confidence. And I think next week they're just gonna blow off with the new rates, right? They're just gonna blow off. I want to say thanks to the virus, we are still in the seller's market like we never seen before. Inventories in some areas is below 2 months.
Yeah.
Inventories, actually, I was in a presentation for the Kendall office. Rental inventory in Kendall is down to 15 days. Single family homes. 15 days of inventory. That's it. So if you show a rental and they say, I want to think about it, say, no, don't think about it. That will be gone tomorrow.
Yeah.
And housing is the same. Bidding wars are back up. And remember, hyper local. Yeah. That's my phrase for the day is, last was swoosh. My economy recovery is a swoosh, not a V. I think hyper local is what you need to understand. Hyper local. Every neighborhood is completely different than another one. So we are seeing bidding wars in some of our listings. And it's interesting. It's interesting. So this is my recap of everything we spoke about. What do you want to throw in there, my friend?
No, the only thing that I want to add to that is if you followed the program that Ernesto has been preaching for the last few months, you know, getting yourself ready for coming out of this pandemic, you're starting to see the benefits of that now. Because if you look at it from a real estate professional standpoint, right? If now you're starting that race, there were people that had begun that race in March. So they're way ahead of you. With inventory being as low as it is, you know, they've been preparing for this and preparing for this. And I mean, now they're just taking off. I've seen, you know, it go straight like this out of Boca. So
it's an interesting thing that has taken place, and I wanted to share one last thing. It was some data regarding our local market. So in our local market, inventory right now, active inventory at the end of March, sat at 4,000 single family homes in Broward County, sat at 4,924. That means that we are consuming 1,350 a month. What is that, Larry? 2.5 months? 3 months? 3 months of inventory?
3 months, yeah.
All right, 3 months of inventory. So let's do math. So you need 6 to 7 months of inventory to have a normal market, right? A normal market, that's what you need. So if we're consuming 1,500 homes a month, and we need 7 months of inventory, we need 10,000 homes actively for sale in Broward County.
Yep.
10,000 homes. And we're sitting today at 4,000. So we need to more than double overnight. You need to double the inventory of homes.
More than 100%.
To get to an even number. Even. So that's at the moment that even. Then to have a disruption, you need to get somewhere between 8 and 9. So now you're talking about, you need to go from 4,900 homes for sale to 14,900 homes for sale for it to be a buyer's market. Buyers are driving the bus, right? So if that doesn't happen, we will still be like everybody says, oh, but 6 months is bad. No, 6 months of inventory in 6-7 months is what you want. Is because you don't want crazy appreciation. You don't want 30% per year. We lived through that. Yep. That ends in a bad way, right? Salaries don't go up 30% per year. Therefore, homes should not go up 30% per year.
Right.
If you cannot understand that math, you're in it to make a buck today. You're not in it to make a career, right? 2 to 3% appreciation. It's a number that I always shoot for. I think that's a perfect number. Salaries appreciate the same rate. So, people can buy a house, have kids, raise their kids, and have and enjoy it, right? So and make the best investment for their retirement, because we all are going that way. Some of us faster than others, Larry. So we are all heading that way. So you need to have put away a nest egg, and I think you said 45. The past 10 years, single family homes, Broward County have gone up 45%. So if you bought a house in 2009, look at your value today, you're 45% higher than that. Right. So we need.
It's funny you say that, because consistently over the last 100 months or 100 quarters, there has been an increase in property values in the state of Florida.
Yeah,
that's crazy. It goes to show the demand, supply, and I say this all the time. Real estate is based on supply and demand. Now you are the number one state in influx of people moving to. That increases your demand. When demand goes up and supply is down, prices have to go up. That's just how it works. It's very localized to where it is, but the truth is, South Florida, Central Florida, those are your hot spots. So you're going to feel it the most in these areas.
So I just got a text from somebody, and I want to repeat. I'm talking single family homes.
Mm-hmm.
Single family homes. I might do a mid-year condo market review, but for that one, I'm going to wear a helmet because that's a different ball. That's a different monster.
Mm-hmm.
There's some areas in Dade County that have 47 months of inventory, or other ones have 56 months of inventory. So I'm talking single family homes. So if you take anything away from this presentation is, where should I put my energy? Where should I get up tomorrow morning and prospect? Single family homes. Single family home. That is the market. That is what's driving the market right now. That's what's going to drive the market for the unforeseeable future. First-time home buyers. Those millennials that everybody said they're never going to buy a home. They're always going to live in a condo where their pet rock, and they're buying homes at a pace that you cannot believe. And you know what? You know where they're going? The burbs, suburbs. Yep. They want the suburbs now more than ever. They want good internet so they can work from home, and they want the burbs. They want a jogging path, a biking path. They have realized that their grandparents, remember the boomers that went out to the burbs that everybody trashed, they realized that grandpa and grandma were right. The burbs is where it's at.
Yep.
So I might do this. I might do a mid-month next month talking about the condo market and just about the condo market. And that will be a reality check. I think I'm going to call that one reality check. But single family homes, it's still the best way for you to put your energy into this market. So for those asking me, hey, are you talking about the whole market? I'm talking about single family homes. I'm not talking about condos. That's a whole different monster, a whole different show, a whole bunch of different data that it's different because it is. So that is what I have left on closing. I'm going to check if there's any questions, Larry, if you want to say anything else left on closing.
No, I mean, look, a long time ago, somebody smarter than me said to me, if the market's up, a good real estate agent can make money. If the market's down, a good real estate agent can make money. I mean, you just have to know how to adapt. And like we said numerous times throughout this presentation, Floridians, we adapt well. We make changes. We make the necessary changes to make ourselves be put in a better position. That's all we're doing right now, is making the necessary changes based on the data. If you look at what the data is showing, South Florida is still one of the hottest spots to be in.
Not just because it was 102 degrees yesterday with the humidity built into it. Not just because of that.
Oh, that humidity.
Larry, the only question I have, and I think we'll do this for the next presentation, is, okay, can you play the guitar live?
Can I play the guitar?
That's the last question I just got. Can Larry do a live performance?
So one of these days, I'll share with everybody the story behind the guitar. I don't even know how to play the guitar. It was a gift that was given to me. We'll just leave it like that.
All right. Well, I want to thank you for your time. I want to thank everybody that's watching. I'm going to share to all the Canvas agents that are watching. I'm going to send you guys a presentation and the video so you can have it, so you can share it with your buyers or sellers. If you're not a Canvas agent and you want this presentation, just leave me a message below, and or send me a message, and I'll get it over to you. My email is evega@canvasre.com, evega@canvasre.com. It has been a pleasure spending this time with you today. Like I said, I think I'm going to come back mid-month and do a condo market update. Otherwise, I'll be back at the end of the month with new numbers to see if we are a V or a swoosh real estate economy. Thank you, my friend. Have a great weekend.